The Bank of Canada has raised its key interest rate for the sixth consecutive time, bringing it to 3.75%. Governor Tiff Macklem is making it clear that more rate hikes are coming as inflation stays hot. But he says the central bank is, quote, getting closer to the end of this tightening phase. However, we're not there yet. BMO chief economist Douglas Porter said he still expects the Bank of Canada to take its key interest rate above 4%. As more interest rates loom over Canadians already facing inflation, it may be hard to stay positive amid these times. But some argue that there's always a way. Well, joining us now to share his point of view is Brendan Caldwell, director at Caldwell Securities Ltd. Brendan, welcome back.
Thank you, Nima. Always great to be here.
Now, there seems to be a lot of negativity out there, Brendan, and reasonably so given what we're facing right now. But is it all bad news when it comes to investors in particular?
In particular, I would say no, because for all the bad news that's out there, unless there's some other weird thing that we hadn't anticipated, or at least we thought was unlikely but possible, I don't want to enumerate them, but for all the bad news that's out there, all of it seems to be in the market right now, and the market isn't doing too badly. It's had a couple of strong days this week. It's sort of flat to middling today, but it's not all bad, even though interest rates are going up, even though that war in Iraq, the war in Ukraine, I got to get my invective right. My war in Ukraine is still going on. The world has absorbed all the bad news and kept on going, inflation and all of it. So I don't think it's necessarily all negative for investors or anyone else for that matter.
And that's good to hear, Brendan. Now, in terms of these rate hikes, the sixth consecutive rate hike by the Bank of Canada, how do you expect this to impact investors and Canadians?
Well, I think Canadians as a whole, the cost of everything is going up. And when they raise interest rates, the Bank of Canada and the banks, it does make the cost of borrowing, it makes the cost of everything higher, but that's the intent. The idea is to make everything more expensive and therefore slow down the economy. But the immediate effect of raising interest rates by making everything more expensive is, in a world where everything's getting more expensive, and that's what inflation means, the effect of raising interest rates is to actually accelerate inflation until it doesn't. What the Bank of Canada, I think, is saying is that perhaps they're close to have done enough. I'm not sure about that. They do not want to see another a stagflation world where we have interest rates and inflation rates in the double digits, and yet the world isn't growing, at least not in real terms, or at least the economy is not growing in real terms. So I think they will be tending to be more aggressive. And actually, this is the most aggressive the bank has been, I think, ever. Raising the interest rate, the Bank of Canada rate 50 basis points was actually less than what people had expected. But even raising a 50 basis points is unusual in a historical context.
Now, there's another thing to consider, especially in October, considering that investors get anxious due to something called the October effect. So, what exactly is the October effect, Brendan, and should we be worried about it?
No is the answer to the second question. The answer to the first question is just the two historic market crashes. Believe it or not, I'm only old enough to remember one of them. The crash of 29 is beyond my range. I've only read about it, but I was sentient, somewhat, as much as a 17-year-old can be in 87. Those two big crashes, 29 and 87, were in the month of October. But they were kind of earlier in the month. I think if we were going to have a crash in October, we would have had it already. So the flip side of it is sell in May and go away. So that the 6 months between May and October tend to be the worst. The market does tend to get better seasonally, historically, from this point onward. So no, I don't think investors need to be worried from a seasonal perspective.
All right, Brendan, looks like we've got about a minute left here, but some may consider tax loss selling at this time. So what are your thoughts on that, Brendan?
If you're going to sell stocks for tax reasons, so you've owned a stock at $100, it was a tech stock, it's now at $25, which is like a lot of them. But you really like the company, and yet you want to take the tax losses. First and foremost, do anything for tax reasons, it usually bites you. But if you're going to do something for tax reasons, I do it now, and then you have a chance this year to look at buying it back. Because I do think the stocks that have been hit hard, there's going to be a number of investors saying, yeah, I got to get this off the sheets for optical reasons, tax reasons, whatever reason between now and the end of the year. So I think while the market may continue to do well, the stocks that have been hit the hardest may get another knockdown between now and the end of the year. But the flip side of that is from January onward, I think the market as a whole and these stocks that have been knocked down may have a bigger than expected rally.
All right, Brendan, always great advice. Thank you again for your time today.
Thank you, Nima.
We'll be right back on Forum Daily News.